start off and tell you that it's actually, I apologize, I'm going to talk about the market in a second, but I got to talk about me and my family for just a moment to start off, because it's been a very celebratory week in my house recently. And that is that we finally got my daughter, her husband, and 2 of their children to move out into their new home after 6 months in our home. So when my second granddaughter was born, they got too big for their apartment, took a while to buy a new place. But the reason I bring this up is not because my house is nice and quiet right now, but one of the things that we figured after 22 years of not seeing this in our home, we had diapers everywhere. Now, why do I bring that up? Because if you really think about it, we accept things at kind of face value, and I always talk about perception and reality. So if you have a curious mind and you have an analytical mind, you start to realize certain things. So if you'll ever notice, children's diapers go under the brand names of Huggies, Loves, Pampers, but adult incontinence products go under the name Depends. So the question is why, if they serve the exact same purpose, they have different names. And I finally figured it out, okay, that if you have a baby who soils themselves, you will change them, you'll put a new diaper on, you will still hug them, you will still love them, you will still pamper them. But if it's an adult, it really depends if you're in the will, okay? And I suspect a number of you will tell that joke a few times. So I get to talk about my favorite topic, the market. And we've seen some volatility spikes recently, and probably not that surprising. Now, markets are very much linked to earnings. If you look at it historically, there are periods of time where they get out of sync, which was, for example, during the bubble period of 2000, where the blue line is ahead of the red line. There's a, okay, it's there, but I don't, oh, there we go. So like here in 2000, and then in 2011-12, you can see kind of where the earnings keep going up, the market held back because of the concerns about the periphery crisis in Europe. So sometimes sentiment overwhelms the earnings, but earnings have been moving higher, markets have been moving higher, and in particular, they've been moving higher since the election of President Trump. 2 reasons for that. One, a view of pro-business, pro-growth agenda, particularly on the regulatory side, but most recently, and think about November, December, where we started seeing markets rallying alongside the movement on the tax cut program coming a lot faster than people had initially anticipated. So what are our targets for the market? Pretty much where we are right now, 2,800 for the S&P earning, for the S&P market. 2018, we're looking at 150, 150 of earnings, up about 14%. Nearly half of that is just coming from the tax cut, and the rest of it's kind of core growth. And we're only assuming $9 of earnings from the tax cut, even though you could probably, if you really worked at it, you'd probably come up to $12 to $14 ranges for the benefits of tax cuts. But not all companies are going to benefit from those tax cuts in the form that they're going to take it to the bottom line. So for example, a number of regional banks have said 50% of that savings on the tax windfall will be used for the purposes of being more competitive in terms of the terms they provide to companies, as they battle not just other banks, but also the shadow banking system. If you look at a number of the retailers, because they're competing with the online marketplace, they probably are going to have to give that back in pricing and not actually capture it at the bottom line. And I gave you more examples of companies. One of the supermarket companies actually basically said missed their numbers this past week, all because they're going to have to use the benefits of the taxes or the tax cuts to kind of compete more aggressively with the Whole Foods of the world and now part of Amazon. So you're seeing that, you know, the initial excitement may have done something else, which means we raised expectations, and the best way to think about it, today's upward revision is tomorrow's higher hurdle for companies to get over. So most of the people in this room could probably run around a track and jump a 1-foot hurdle if it was in front of them, but you probably would have a little bit more difficulty if that was a 3-foot hurdle, unless you're, you know, in as good shape as Chris. But so we think that, yes, the market will go up, but you won't get the full benefit of earnings because A, it probably won't be as exciting, and 2, some inflationary pressures, which we're going to talk about. Now, the outlook for the economy is actually pretty good in the U.S. So if you look at the top left-hand chart here, what it basically shows you is credit conditions continue to improve with that blue line going up, and 9 months later, industrial activity improves as well. Very important for shipping activity, for freight, et cetera. but more importantly, it's tied very closely to earnings trends. Industrial production earnings move in incredibly close, allegiance to each other. And the primary reason is you're absorbing your overhead fixed costs. So the cyclicality of earnings is tied to cyclical businesses. That should not surprise anybody. The way I generally describe it is that very few people in this room buy 100 boxes of Tide when the economy is good and one when it's bad. You buy it as you need to launder your clothing. So that's pretty stable stuff. But we're probably not going to buy a new car tomorrow if you just got fired today. Right? Companies who are losing money aren't going to go out radically and start spending money when they don't have the cash flow. So the cyclicality of earnings is cyclicality of the businesses, and that actually looks pretty good. Now, this is fascinating to me. So this is the National Federation of Independent Business Survey, small business survey. Is this a good time to expand? Got a lot of history here. They are quite excited. So it's a combination of a better economy, it's a combination of tax cuts, a combination of regulatory reform. All these things have given that really spiky kind of view of, yes, it is a good time to expand capacity. When we look at nearly 790 companies that our analysts cover in the US, we see that as well in the aggregate numbers in billions of dollars. The blue here is energy, the red is non-energy. And notice that when the energy sector kind of pulled back starting from the peak in 2014, the red line kept growing. In other words, energy, there was still capital spending growth in the US, heavily led by technology, but nonetheless still growing, and growing in terms of projections for 2018 even more, and that now shows about an 8% increase. For those who want to see the hard numbers, we have it a little later. Now, this is pretty interesting to me as well. Small business hiring intentions, the blue line tracks what happens a year later. On the red line, the inverted axis here. So when that red line is going up, it's going down. And when it's going down, it's going up. I'm not trying to confuse you. I am trying to show you the relationship. When small businesses that they're going to hire, about a year later, we tend to see improving trends on unemployment rates. Now, I could have made this argument a year ago and told you that wage inflation was going to occur. But that didn't really play out. So let me show you the really important stuff about wage inflation. And I was just at our industrials conference 2 weeks ago in Miami. The weather was far better than this morning. I was at an energy conference in Cabo, Mexico. I get to go to some really fun spots. I was just asked to go to Nassau, Bahamas, and I'm pretty much going to say yes. On the other hand, the trip to Iceland's off. But when you listen to the companies and you hear what they're saying, they're telling you they're starting to see labor compensation pressures really playing out in the real world. So what I really want to focus on here is this interesting chart. What we're looking on the right-hand axis now is the differential between U6 and U3 unemployment rates. Again, inverted, so if it's going up, it's going down, right? So hiring intentions are rising, and that red line follows by about a year, and it would suggest that we're going to go from about 4%, call it, to about 3% in the course of the next 12 months, and maybe even a little bit higher if you look at the spike in hiring intentions. So what's going on here? Why do I care so much about U6 and U3 unemployment? U3 unemployment rate is the number you're most used to seeing, 4.1% number that was reported yesterday, or not yesterday, Friday. The U6 number includes, you gotta love economists because they come up with great terminology, marginally attached workers. Marginally attached is kind of the way I think about it. If I'm not married now, so I can't do this, but go to a bar and try to find somebody to hook up with. That's marginally attached, okay? But marginally attached workers means people who are looking to partake in the economy, but maybe they're working part-time and they'd like to work full-time. So if you think about it from a businessman's perspective or a business person's perspective, I don't want to be attacked for not being proper. I'm Canadian, and for those of you who may have noticed, Justin Trudeau, the Prime Minister of Canada, was asked a question on a trip recently by somebody, and she said, would this be good for mankind? And he said, you mean people kind? And he's been slaughtered in the press because of that. Because one meme that I saw was just beyond funny. I apologize, I was in Canada a week ago, and I heard this one where a guy put out a letter or a note to the president saying, if my name is Guy Manson, or is it? But it was his name. Anyway, so the concept of hiring intentions and that gap is really important. If you run a business, what you'd like to do is capture the benefit of business trends and you'll arbitrage the potential workforce, think of the U6 workforce against your U3 workforce and your permanent workforce. So almost think of it in these terms. If you have 10 people working for you 40 hours a week, $10 an hour, and then you have 3 people working for you part-time, 20 hours a week, $10 an hour, and you get some new orders, what you might say is, I'm going to take the 20-hour person, take them to 30 hours, because I don't want to pay my 40-hour people overtime, or 1.5 times, or $15 to meet the same order. So you will do this all day long as you can. And this is why, when you have a fairly wide gap the last couple of years, even as the unemployment rate was going down, you literally didn't have to give people work, job or raises. So again, even in the instance where you go to that part-time worker and say, okay, now work 30 hours, your other 10 full-time workers are kind of ticked off because they did not get the wage increase. Now, before I prove what I just said, because right now, so far, I've only given you a rationalization or a logical, reasonable perspective. I'm about to prove it to you in a moment. But before I do, I'm going to ask you a rhetorical question. That doesn't mean anybody has to answer. You won't even know the answer, although you'll know that it exists. So anybody in the back, don't go, ooh, 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 because I'm not going to call on you. And that is the following. How many times have you heard in the past couple of years that the reason that wages are suppressed is because of innovative technological disruption? The so-called Amazon effect. The idea that you and I can walk into a store anywhere, if we're so 20th century and we still go to stores, and you can look on your phone and see, where can I buy this same item cheaper? Right? This idea is viewed as driving wages down. I'm about to prove to you that that's not true. So what we've done here is we've looked at the same U3, U6 unemployment rate. In this case, it's scaling higher. And we look at wage growth based on the employment cost index year-over-year changes. Here is where the fourth quarter of this past year is. Here's where the third quarter was this past year. Basically exactly where they should be, exactly on the line. This is since 2001, so we've got all of the new technology gizmos here. You still run an R squared at 0.83, and if you were to move from 4%, which is kind of where we're at today, to 3%, you're talking at over 3.5% wage increases, moving up from 2.5. So don't get that excited on Friday when the number showed only 2.6% after the 2.9% number in January. I think people got excited in the market, but I think they're overly sanguine. The trend is not going to be your friend on labor costs, which means companies are going to desperately try to raise prices. Let me show you something else, commodity prices and the 10-year break even. So the blue line is the 10-year yield break even, the TIPS break even, the idea of what the bond market believes inflation expectations are, not what I believe, because nobody really cares what I think. I've been married over 30 years. I got 3 kids. I have plenty of evidence. Nobody really cares what I think. But what I want to show you here is that when oil prices and metal prices go up, then so does the blue line. And that's on top of what we're seeing in labor costs changing. So it is very likely that companies are going to be raising prices because they don't want to eat the margins. Well, that means you get some inflation pressures. Is that a disaster for the economy or for markets? No. Anywhere between 2 and 4%, this goes back over 50 years, you're talking about an 18 multiple. Now, I have $151.50 earnings estimate. There are people out there with 155, 156, even if you believe those numbers, which I'm not convinced of. And you put an 18 multiple on it, you get to 2,800 on the S&P. You do not get to 3,100 or 3,150, the more bullish calls on the street. So it's not that I'm negative. I wrote a report 2 weeks ago called "The Bull in Bearish Clothing." I'm still bullish. I just don't think you should be expecting to crush it this year after making over 20% last year. That's greed. That's not normal. So you're entitled to your greed. It's a free country. But let's talk about where greed is. So our panic euphoria model shows we got into euphoria around Christmas time this past year, when everybody got really excited about the tax reform. And we were deeply worried about it. We were going around telling clients, don't be this excited, because when you hit euphoria, you've got about a 70% chance of losing money in the next 12 months. And we were out there in January really trying to tell people this, and they were saying, hey, Tobias, I don't want to hear this. Stop harshing my mellow. Okay, I like the market going up. Earnings revisions are good. The economy's good. Why are you casting aspersions? Don't jinx it. Like I have that kind of power. So now we've seen some volatility and the market's pulled back, or at least the index has pulled back as people have kind of readjusted some of their portfolios. Now they're still complacent which is why we got a 400-point rally on Friday. They were happy to kind of get out of that worry that they were, that kind of got imposed on them in early February. So, I wouldn't get that excited. I'd be a little careful. Now, again, CapEx is still fine. The Duke University CFO survey is picking up, which the red line will follow. If you look at kind of a measure of activity, when we look at industrial production trends, we can look at rail car utilization, and that's kind of reflecting what's going on as well, and has some positive trends. Now, we watch in this case, the industrial sector performance, which is what that blue line is, tracking what happens with utilization rates, which makes sense. It's another way of kind of getting a sense of what's going on underneath the economy. Okay. I'm going to have to ask somebody to turn to the next slide because for some reason this has stopped working. Is there somebody in the back of the room who can help me here? Okay. So this looks at the data that I was talking about. There's a lot of numbers here. I'll just make it easier for you. In November, when we looked at 2018 capital spending intentions of those 790 companies I mentioned before, they were telling us capital spending would be up about 3% this year. We did the same thing in February after most of the companies had reported their earnings, and now they're telling us about 8% increase in capital spending. 8 of the 9 sectors in here, we take financials out for given the way they report their numbers, but 8 of the 9 sectors increased their expectations for capital spending since November. So clearly businesses are feeling a little bit more confident. And again, we could debate why they're feeling more confident, but nonetheless they are. And that's kind of very exciting. Now I like to point this out to people as well. Capital spending, ex energy, never fell. People talk about capital spending having had a really, really tough time. We had a mini recession in 2015-16. No, we didn't. We had an energy depression. But the rest of the economy didn't do so bad. Here's energy capital spending. And you can kind of see as a percent of GDP plunging from 2014's high and now rebounding. Now, this all tells me one very important thing, which again, I need help in the back here. To go to the next slide. How do I want to invest? Well, the tech sector looks overvalued to us, but certain sectors look pretty interesting to us. Oil, gas, and equipment services are poised to perform. Same thing for industrial conglomerates. When that red line goes below 0, you usually get that shaded outperformance potential. So we're looking at what drives stock prices, not what is cheap or expensive. I honestly don't care what's cheap or expensive. I know that sounds horrible for somebody from the Wall Street community. But I've bought cheap stocks that have found ways to become cheaper. I've sold what I deemed expensive, and they keep going up, torturing me from a distance. I know this is an incredibly unique experience that only I have ever suffered from, because portfolio managers aren't hated as much by God as I am. But we want to know what factors. If the stock is expensive and it keeps going up, then I'm fine with owning it and relative to the market. I just want to know how markets treat information, not the way I would like the market to treat information. So we backtest this. If I look at, sorry, I need help in the back again. If I look at which groups I want to buy or don't want to buy, the yellow just means they were the recent changes that we did in January. So we moved, for example, retailing down after a 23% move since October. By that time, we moved a few areas up, like capital goods, particularly in areas like conglomerates and component manufacturers. And you can see kind of we're more cyclically oriented, although we do have a few areas like healthcare equipment and services that still look interesting to us. Deal flow is kind of helpful in that front. Now, whoops, that worked. Go back to the risks, please. So what do we have to worry about? So certainly central bank policy errors, this idea that we have some inflation and they get literally too worried and they race and kind of kill the golden goose. And I think they don't want to do that, and I think they're very wary of it. But nonetheless, if inflation generally kicks up, they're going to have to deal with it. Certainly trade protectionism, the most recent steel and aluminum tariffs on top of what we saw with solar panels, for example, or lumber out of Canada, that those kind of things could get out of hand, and that would be, in our minds, disastrous. I don't think it's necessarily shared by everybody in the White House in terms of that, but we think that that is a serious problem that we have to keep worrying about. The good news, I guess, is that when the president did sign the tariffs in place, he exempted Canada and Mexico, and certainly we're going to have to watch the NAFTA trade issues on that front. Geopolitical events, maybe this meeting with North Korea will end up being a good thing. We'll have to wait and see. But there are a lot of places around the world that look far more unstable than they did if we went back 10, 20 years ago. And that's not necessarily because of any administrations, just there is a lot of bad stuff going on. Could anything escalate? Small business so far seem to want to embrace these animal spirits, as I showed you that chart on hiring intentions and the capital expansion idea. But what if they don't, carry forward and continue on it? And then, obviously, interest rates moving higher, we think has an issue for the markets. Our view on this would be, again, be a little bit more focused on value over growth, be more focused on cyclicals versus defensives. Those tend to work better when interest rates and inflation are moving higher. And now I'll just put up all these wonderful disclaimers that I'm sure you guys are thrilled to read and go through. This is what keeps lawyers employed at Citi. Anyway, I don't know if I have a minute or two for questions. 1 minute. Any questions? There's somebody in the back I can't quite see. There's nobody in the back. Okay. Wait, there's? Oh, here, right here. Gentleman right up here in the tan jacket.
Thanks, Tobias. That was a great presentation. Just any thoughts about the midterm elections, how you think that may or may not affect the economy, the markets?
So I do think the midterm elections matter. Let's put it this way. I was with our head of government affairs last week at a conference in Florida, and he was asked that specific question. So I'm really going to channel my inner John Emling. So the Senate looks really, really tough for the Republicans to lose. That doesn't mean they won't, but it looks tough for them to lose. There are 10 states that Donald Trump won by better than 20% margins where Democrats are defending seats. I saw a poll over the weekend that said 5 of those are likely to flip to the Republicans. Not one poll, there's a series of polls. So it's hard to imagine that the Republicans will lose seats. There's only one seat the Republicans looks vulnerable, and that's Senator Heller in Nevada. The House is a totally different game. They've lost most of the House elections since the presidential election. There are 37 or 38 Republican congressmen retiring and not running for re-election. That puts them more in play because incumbents tend to have a better name recognition, have the ability to kind of spread some pork around to keep them in place. So the House is vulnerable. It isn't a done deal. It's probably 60-40, the Democrats take control of the House. What would likely happen, they couldn't really pass anything without the Senate joining them, and the president, even if he got it, the president could veto it because he probably don't have a veto-proof structure in Congress after the elections. But you could have a lot of noise, things that bogged down in hearings and stuff like that. There is a wing, part of the Democratic Party's wing, kind of the more progressive wing, which would love to impeach the president again. It's unlikely they could do that, certainly without the Senate. The same thing happened under Clinton, where the House impeached him, but the Senate didn't. So it's really hard to see that. The Mueller investigations would be far more problematic if they find something real. And that really they could stick the president, not his son, with, So, again, the simple answer is the House looks like it could swing, but we're still far away, and the Senate unlikely to swing to the Democrats, so it's going to be a lot of fire and fury and a lot of noise, but probably not that much reality. I think markets might get a bit worried about it, but that's a totally different issue. I think I'm out of time. So I will step down. Take care.